In this video, I'll be sharing with you 6 steps on how you can trade credit spreads on Moomoo's latest desktop platform, which is also the sponsor of this video. Note that this is based on my personal experience. Options trading carries high risk and may not be applicable to everyone. So please ensure you understand the risk of trading options before you proceed. But before I start, if you are new to Moomoo Singapore, you can sign up to them using my exclusive link down below to earn up to 2,266 SGD worth of welcome rewards. Plus, both new and existing users will get to enjoy zero commission for Hong Kong stock trading for 30 days, zero commission on US stocks, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. First up, what is a credit spread? In simple terms, credit spread is an option strategy which will give you an upfront credit or premium or money or whatever you want to call it when you perform this trade. Take for example, if I sell this credit spread, I would immediately receive $145. This money is now in my account and I can do whatever I want with it, like buying shares, investing into a money market fund to earn a yield, and so on. However, it's important to note that this trade is still open, and as long as it is open, all these are unrealized profits, and you will only realize this profit when you close this trade. Most people get confused by this because they see that they receive money in their accounts and yet there's still an unrealized profit and loss on the trade. So in order to truly profit from credit spread, I will need to close the trade by buying back the credit spread at a lower price than when I've sold it. For example, if I first receive $145 at the start and I close this trade when it is at $100, I've profited $45 from this trade. On the other hand, if I close this trade at a higher price, like $200, then I will have lost $55. Now, there are 2 types of credit spread. The first one is call credit spread. Some like to call this a bear call spread. As the name suggests, this is a bearish strategy. It is used when traders believe that the stock wouldn't go above a certain price. Take for example, let's say the stock is at here now, and I don't believe that it can continue to go up. In that case, I can do a call credit spread at a higher strike, which will give me a $140 upfront credit. On the other hand, if I'm feeling bullish and I don't believe the stock will drop below a certain price, I can do a second type of credit spread called the put credit spread, or what some people like to call the bull put spread. For example, if I don't believe that the stock can go below this price, I can do a put credit spread at this range, which will give me a $150 upfront credit. The reason credit spreads are so good is because of these few reasons. 1. I don't have to be 100% right on my trades in order to be profitable. For example, in this bear call spread, I will profit when the stock goes sideways, when the stock goes down, and even if the stock goes up, as long as it doesn't reach my strike price, I will still profit. This is also why credit spreads have a high win rate. You can see that from Tasty Trade's study, credit spreads tend to have a win rate of anywhere between 80 to 90%. This is way higher win rate as compared to your normal trading, where once you put on a trade, the stock can either go up or down, ignoring any technicals of course, which means you will only have a 50% chance of profit. 2. Credit spread is a risk-defined strategy, meaning my max loss is capped and I will never lose more than what I risk. For example, for this put credit spread, my max loss is $850. So even if the stock crashes all the way down, I will only lose at most $850. And lastly, I only need a small capital to start trading credit spreads. This is unlike covered calls or cash secured puts, where one will need enough capital to buy 100 stocks. Like if I want to do cash secured puts on Google, I will need around $18,000 to do it, which is a lot of money. On the other hand, I can start trading credit spreads with even as little as $100. So with that out of the way, let's talk about how I will perform a credit spread. Again, take note that options trading may not be suitable for everyone, so please do your own research before you proceed. Step number 1. Choosing my underlying. The trick to getting high probability of profit is by choosing stocks where the movements are predictable and yet still give a decent premium. So here is my watch list. I have a few of the top tech stocks that I'm constantly monitoring, such as Apple, Google, Amazon, and Tesla, which of course is not a recommendation, yeah. So please do your own research. The reason I chose them is because they are a lot less volatile as compared to other stocks like DJT or Palantir, which means there's a much higher likelihood of staying within the expected move. At the same time, their implied volatilities are high enough that they can give decent premiums. Not just that, most of them have good financials, which means during normal times, you can expect the stock to move in a certain direction. Side note, moomoo Desktop lets me easily check the implied volatility of these stocks. To find it, I can just head over to the Options tab, Analysis, and under Volatility Analysis, I'll be able to see both the implied and historical volatility to help me assess whether volatility is high or not. However, the issue with these stocks is that they can still be volatile, especially during earnings announcements. For example, if you head over to the Options Earnings tab, you can see that in most cases, the realized move tends to go past the expected move. So one way to avoid these volatile movements is to trade ETFs, as they tend to have lesser movements and have a higher likelihood of staying within their expected range, which will give me a higher probability of profiting on my trades. Next, once I've identified the stocks and ETFs that I want to do credit spreads on, the next step is to decide when is the best time to sell credit spreads. So first, as mentioned earlier, if I'm selling options on stocks, I would want to avoid selling them when there's upcoming earnings because it's too unpredictable. 2. I want to identify whether a stock is overbought or oversold. One easy way I can do that is by looking at the RSI indicator. If the RSI is at the 70 level, this means the stock is in the overbought territory and may reverse down. In that case, I can look to sell a call credit spread above the stock price and wait for it to go down. On the other hand, if the RSI is at the 30 level, this means the stock is in the oversold territory and may reverse up. In this case, I can look to sell a put credit spread below the stock price and wait for it to rebound up. Now, this is not to say that just because it is been overbought or oversold, it will definitely reverse. The stock can remain overbought or oversold for a very long time, especially when the trend is very strong, like what is happening to Palantir right now. So in order to improve my profitability of success even further, I can try to identify what is the current trend and what's the likelihood of it going in a certain direction. There are many tools on moomoo Desktop that allows me to do this. For example, moomoo Desktop has 100 plus technical indicators, 38 plus drawing tools, and customizable indicators. But personally, I will first look at the MACD indicator to tell me whether the momentum is about to change or not. Otherwise, if I right click on the charts, moomoo Desktop has something called the Trend Projection tool to help me find stocks that have a similar trend to see where it could go next. This is not a guarantee, so you will still need to decide for yourself, yeah? Then in the Options tab, I can also click on Analysis to see all kinds of option analysis. But the one that I find most useful is Volatility Smile, which you will find if you scroll all the way down. This tells me where the market thinks the stock will move next. If the chart is left skewed, this means the market is bearish and thinks that the stock will probably go down. But if the chart is right skewed, this means the market is bullish. But here's a question. With so many stocks in my watch list, how do I even keep track of every one of them to know which is overbought or oversold? To do that, I can head over to the Custom tab, which allows me to build my own dashboard so that I can quickly get through each one of them in a single glance. For example, here I've added individual charts for stocks that I want to monitor, and for each stock, there's an RSI indicator so that I can easily tell when stocks are overbought or oversold. Moving on, the next step is to choose the number of days to expiration. Is it better to go for a short 1 to 7 DTE where the options will expire faster, or is it better to go for longer DTEs? Again, we can look back at the studies done by Tasty Trade. What they found was that at below 45 days to expiration, the expected move of the stock is lower than the realized move. But when you go 45 DTE and above, the expected move is consistently bigger than the realized move. But at the same time, I don't want to go too far out till there's not much time decay going on. So the sweet spot would be around the 45 DTE. Here's another study showing the same thing. 45 DTEs will give me a much better success rate as compared to shorter DTEs. So So if I want to have an extra edge when selling credit spreads, I will want to go for the 45 DTE. In moomoo desktop, by default, I will see the DTEs in list form. If I click on the settings button on the right, I'm able to switch the expiration date layout over to the tab form, but I prefer leaving it in the list form as I will get to see a lot more info here, such as expiring in how many days, the implied volatility, and most importantly, the expected price movement of the stock during that time frame. This will be super helpful in the next step for when I'm deciding which strike price to choose later on, which brings us to step 4. Choosing the strike price. For this, I will look at the delta because delta will tell me the rough probability of the option going in the money. For example, this option has a delta of 34, which means there's a 34% chance of it going in the money. Or if you flip it, it also means there's a 64% chance of it not going in the money and me end up being profitable. So which is the best delta to go for? For this, I always want to balance between profitability versus probability. Because on one hand, I wouldn't want to go too low until there's very little premium to earn. And on the other hand, I don't want to go too high of a delta till there's very little chance of success. Again, referring to Tasty Trade studies, what they found was that a delta of between 10 to 30 would give me the highest return on capital per day. Or more specifically, Tasty Trade found that if I go for the 30 delta, I will have a lower success rate but higher profit. And if I go for the 16 delta, I will have a higher success rate but lower profit. The choice of delta often depends on one's level of confidence. For those with a higher degree of confidence, targeting a delta in the range of 25 to 30 may be appropriate. Conversely, if I have a lower level of confidence, aiming for a delta around 16 might be more suitable. Of course, the above are based on my personal experience, so please do your own research before performing this. Other than this, another thing I can do to improve my probability of success is to choose the strike price at slightly beyond the support and resistance levels. For example, this stock bounced off this price, which means it has become a resistance level. So what I can do is choose my strike price above this level. Now, once I've identified my strike price, the next step is to place my trades. By default, moomoo desktop only allows me to place a single options trade. So by clicking on it, I will see all the option strategies that it supports. I can choose the vertical spread option, where they'll automatically help me to combine the options together. But personally, I prefer custom, as it will give me the flexibility to build my own spread. In order for me to build a credit spread, I will sell an option at the strike price that I've chosen, then buy a second option at a further strike price. But here's a question, how wide should the credit spreads be? It mostly depends on what is the maximum risk that you want to take. For credit spread, the max loss is equal to the width of the spread minus the premium that I've received. So let's say if I want to risk $500, I can start with a $5 wide spread. And in this case, I will receive a $90 credit, which means my max loss is just $415. So I still have not maxed out my $500 max risk yet. In that case, I can increase my width by another $1. And this time, my total credit becomes $106. And my max loss is $499. Then, to place my trades, just click on the Unlock Trade on the bottom right. Here's a pro tip. Rather than accepting the default limit order, what I will do is click on this price following icon. Then select the mid price. That way, I get a slightly better premium. Then, if it doesn't get filled, I can slowly shift my limit price to the strike price. Once you are ready, just click on Submit to preview your order. And if everything is alright, click Confirm. Once I've chosen the option strategy, I can also use moomoo's option calculator to observe the potential theoretical price changes in options by modifying the parameters, such as the expiration date. Next, when should I exit my trade? According to Tasty Trade, there are generally 3 strategies as how I can exit my position. I can either hold it to expiration, or close at 50% profit, or close at 21 DTE. So, which is better? So, what they found was, if I hold to expiration, while my win ratio is at 85%, my annualized return on capital would also be the lowest. Meaning, I'm not using my capital as efficiently as compared to the other 2 methods. Whereas, if I close the positions at 50% profit, profits, I would have the highest win ratio and highest annualized return on capital, which makes sense because I'm consistently realizing my profits whenever I can. And in a bull market, I'm more likely to be hitting 50% profits earlier. However, the downside is that in huge market crashes, I would encounter the largest loss, since I'm just waiting for the 50% profit to close my position. Lastly, for the 21 TTE method, while the win ratio and annualized return on capital is the lowest, I also won't encounter a large loss, since I'm always closing my positions early. Here's the same thing, but shown as a graph. During market crashes like in 2008, 2011, and 2020, the 50% winner method will see a huge dip since I'm holding it through the crash, whereas closing at 21 TTE would encounter lesser losses. So, should I go for the 50% winner strategy or the 21 TTE strategy? The answer is to use both at the same time. Once I hit the 50% profit, I can close my position and move on to the next trade. Otherwise, if I reach the 21 TTE, I can just close the trade, regardless of whether I'm in profit or not. That's because even though waiting past 21 TTE to close my trade can increase my probability of profits by about 6%, the problem with that is that if the trade doesn't go my way, I can stand to lose up to over 2.5 times as much as compared to closing at 21 TTE. So as long as I can consistently make profits at 50% and close my trades at 21 TTE, I will get the best of both worlds. So that was my 6 steps of trading credit spreads on moomoo desktop. Again, note that the above steps are based on my personal investing experience. If you wish to perform your trade, please do your own research, yeah? As you can see, the moomoo desktop is clean, easy to use, it lets me customize my own dashboard, and it has a ton of useful tools to help me analyze options. To get it, you can use my link down below to head over to Moomoo Singapore's website. At the top right, mouse over the download button, then click on the download now button under Moomoo Desktop to download the Moomoo Desktop app. If you are new to Moomoo, you can sign up using my link down below and get up to 2,266 Singapore dollar rewards when you fulfill the terms and conditions. And if you are trading options with Moomoo, you'll be able to get the first 100 contracts at 0 commission each month. Anyway, hope you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.